What's up, everybody? Welcome back to Trades and Gains. I'm your host, Max Pitts. And, well, let's everybody just take a deep breath. Because if you thought this is going to be a quiet Monday midday tape, congratulations. The market, well, it just laughed in your face. By lunchtime, we've got Treasuries selling off, China quietly tapping the brakes, Elon Musk casually rearranging the future of humanity, Goldman lighting software stocks on fire, and big tech borrowing like it's 1999, but with better graphics. So yeah, let's go ahead and get into it. So here's the market vibe for midday right now. Nobody trusts anybody. The market is borrowing, and everyone is borrowing money at this point. And if you're not, you're underwater. And every asset class is asking the same question. Am I the next thing to break? Stocks are trying to hold it together. Bonds are doing that thing where they smile while backing away slowly. Crypto's still licking its wounds. And software stocks are in the corner asking if this is how newspapers felt in 2003. This isn't panic yet. This is what we like to call some good old confidence erosion. And those are way harder to fix. 4,300 profit on the Tesla calls. Dang, good shit, my guy. And that happened over on our Twitch stream over at Free Wi-Fi Radio. So feel free to come and hang out if you see this, because we are on from market open to market close every day. And I also just have a new thing that I will be showing on stream as well. So let's go ahead and start where the real grown-ups are panicking quietly. The bond market. Overnight, yields move higher after reports that Chinese regulators told banks to limit their U.S. Treasury exposure. Important detail here. This was not China dumping treasuries. This wasn't sell everything and torch the dollar. This was more like, hey, maybe don't keep all your eggs in that basket right now. 10-year yields popped towards 4.25%, and the 30-year pushed near 4.9%. Nothing explosive, but enough to remind the markets that foreign demand is not infinite. And this matters because treasuries don't trade on vibes. These things trade on trust and liquidity. China's treasury holdings are already down more than 50% from their 2013 peak. They're still a top holder, but the direction matters more than the size. The message isn't de-dollarization tomorrow. The message is diversify now, right? So we don't have to panic later. So when multiple countries start saying that quietly at the same time, that's how the structural flow starts to change. Now, before FinTwit loses its mind, let's go ahead and ground this. China cannot nuke the treasury market without nuking themselves. Everybody knows that. The bond market knows that. That's why yields didn't go vertical. Most of China's remaining exposure is short-dated, highly liquid, and held by official institutions, not yellow banks. So this isn't a sell now event. It's a long-term pressure story, right? More issuance, less automatic foreign demand, and higher term premiums over time, which brings us to the real punchline of this market today. Because while China is quietly diversifying, big tech is backing up the money truck. Alphabet is about to raise $15 billion in bonds. Oracle, they went ahead and raised $25 billion, and hyperscalers are expected to borrow $400 billion this year. Now why? Because AI capex is no longer quote-unquote self-funded growth. It's officially a financing event. This is the shift Wall Street is waking up to. The AI boom didn't stop, it changed funding sources. And when markets start asking what happens if earnings don't scale as fast as the debt, this doesn't mean AI is dead. It means the cost of belief is starting to rise. And rising yields don't mix well with long duration cash flows, high multiples, and trust us, monetization is coming narratives. Lisa Sue, sorry, I had something in my throat. Which leads us directly into Goldman Sachs. They came out today and basically said, hey, software investors, you might be in the newspaper industry circa of 2002. That's not a downgrade, that's a historical threat assessment. Their argument is brutal, but it's simple. AI, it isn't cyclical disruption, it's structural margin compression. Earnings visibility is pretty much gone at this point, and markets don't bottom until earnings estimates start to bottom. That's why stocks like Salesforce, ServiceNow, SAP, Thomson Reuters, and Intuit keep getting hit after earnings. This isn't about missing a quarter. This is about terminal value anxiety. The market is asking, if AI automates this, why am I paying 20 times the sales? And there's no quick fix for that, by the way. This is why software is underperforming the NASDAQ by the most in decades. Now let's go ahead and switch gears, because no midday tape is complete without Elon Musk rewriting the future between coffee sips. Over the weekend, Musk announced SpaceX is now focusing on the moon instead of Mars. Now why? Well, because Mars takes 20 plus years. The moon makes money sooner. This is Elon doing something very un-Elon, optimizing for IPO optics. Orbital data centers, satellite infrastructure, launch frequency, and cash flow narratives. Mars is inspiring, but the moon is currently billable. And when SpaceX is reportedly talking about a $1.5 trillion valuation, you better believe that the narrative and the story of this will matter. This isn't sci-fi, this is capital markets. So let's go ahead and zoom out. Here's what ties everything together today. China, it went ahead and diversified quietly. The yields stayed elevated, big tech borrowed aggressively, and while software loses pricing power, AI shifts from hype to finance, and visionaries start telling shorter dated stories. This is not a crash environment, this is a repricing environment. The market isn't asking, is growth dead? It's asking, who deserves my capital at these rates? And that's a much tougher question to answer. So into the close today, here's the checklist. For the 10-year behavior, does 4.25% hold? Software versus NASDAQ, does selling accelerate or is it going to stabilize? Mega cap credit spreads, widening matters more than stock price. The dollar softness, diversification narrative is going to feed into this. And AI sentiment, we're looking at belief versus balance sheets. And if you've been a subscriber of the channel for some time, you know the one thing I've always preached to you guys is the narrative is great and all, but please look at the balance sheet and please look at the margins, because those are the things that are going to tell the story after this hype cycle dies. We called that out, by the way, in June of 2025. Actually, we called it out after GTC when Blackwell was first introduced. So think about it like this market isn't broken, it's just skeptical at the end of the day. And skeptical markets don't crash immediately. They grind, they rotate, and they punish lazy narratives. And that's where we are right now. All right, well, that's your midday reality check you didn't ask for. We'll see who's standing by the close. Don't forget, this channel is powered by Investor Central Club. Use that code SUPERMAX20 to get 20% off your first month at investorcentralclub.com. And I will see you guys in the next video.